There is something happening in the way serious capital is being positioned right now that the mainstream financial press is covering as several separate stories. It is not several separate stories. It is one story. And when you see it as one story, it changes how you interpret everything happening in financial markets right now. The gold correction, the equity valuations, the Fed's frozen posture, the silence from the world's most watched allocators. Let me start with a number. $7.75 trillion. That is the total amount sitting in money market funds in the United States as of the week ending May 6, 2026. A record. It increased by $122 billion in that single week alone. To put that in context, the entire GDP of Japan, the world's fourth largest economy, is approximately $4.2 trillion. The amount sitting in U.S. money market funds right now is almost double that. It is larger than the GDP of Germany. It is larger than the combined GDP of the United Kingdom and France. This is not money being invested. This is money being held, liquid, available, waiting. The question that nobody in mainstream financial media is asking clearly is, waiting for what? And the second question, which is more important, who put it there? This is Capital Briefing. If you are here for the first time, I'd subscribe now before we go any further. Turn on notifications. What we build on this channel is the translation of what institutional capital is doing before the public narrative catches up. The gap between when smart money moves and when retail figures out why is exactly where the most consequential wealth transfers in every economic cycle take place. Subscribe now. Then let me show you what the cash positioning actually means. Before I explain the mechanism, I want to establish something that gets lost in most financial commentary. Cash is not a default. Cash is not what you hold when you have no idea what to do. Among sophisticated allocators, cash is a position. It has a logic. It has a cost-benefit structure. It has a specific set of conditions under which it is deployed. Right now, the largest corporate cash position in the history of American capitalism is held by Berkshire Hathaway, $397.4 billion. That figure was confirmed in the first quarter 2026 earnings report. It is up from $373 billion just 3 months earlier. It now represents more than 30% of Berkshire's total assets, the highest proportion in at least 3 decades. At Berkshire's annual meeting on May 2, 2026, Warren Buffett described current markets in terms that should not be dismissed. "We've never had people in a more gambling mood than now," he said. He cited one-day options and prediction markets as examples of behavior that has crossed from investing into outright gambling. The cash pile keeps growing because Berkshire keeps choosing not to spend it. Buffett has repeatedly said he prefers to buy when fear is rampant, and current valuations do not meet his criteria for aggressive deployment. This mirrors his historical approach, where only 5 of his 60 years in investing were truly ripe for major action. That statement is worth sitting with. 5 moments in 60 years when conditions were genuinely right for decisive action. We are not in one of those moments. And the man with the most cash in corporate history is saying so explicitly, not in a press release, but in the way capital is actually positioned. Now let me explain why this matters beyond Berkshire. Total money market fund assets increased by $122.35 billion to $7.75 trillion for the week ended May 6, 2026. Among taxable money market funds, government funds increased by $109.2 billion in that single week, $109 billion into government money market funds in 7 days. This is not retail investors moving money around. The institutional flows dominate these numbers. Pension funds, endowments, sovereign wealth funds, corporate treasuries, family offices, the people who run the largest pools of capital on the planet are simultaneously, in the same week, increasing their allocation to the most liquid, lowest risk instruments available. That is a signal, not because 1 week of flows is definitive, but because it is not 1 week. It is a pattern that has been building for months, and the magnitude of this week's move is the largest single-week inflow since the initial COVID shock of March 2020. When you see a number like that, The correct question is not what is happening this week. The correct question is, what do institutional allocators know or believe about what is coming next? Let me now explain what I think they see, because the data is not hidden. It is public. It is just rarely assembled into a coherent framework that shows the full picture. The S&P 500 forward PE ratio sits at approximately 21 times earnings, well above its long-run historical average of 16 times. The Buffett indicator, which measures total U.S. stock market capitalization relative to GDP, currently reads around 227%. Buffett himself once said, a reading above 200% is playing with fire. At 227%, you are not playing with fire. You are already inside the fire. This is the first layer of what institutional capital is pricing into its cash positioning. The equity market is not offering sufficient return for its risk at current valuations. The most watched value investors in the world cannot find assets that meet their standard for deployment. When that condition persists for years, and Berkshire has been a net seller of equities for more than 3 consecutive years now, the cash position is not indecision. It is a structural statement about valuation. But the equity valuation story is only one layer. The U.S. national debt stands at $39 trillion. Interest payments on that debt reached approximately $1 trillion annually, more than the federal government spends on defense, and about as much as it spends on Medicare. With debt at 100% of GDP, the U.S. has less fiscal space than at any time in history in case of another war, pandemic, or recession. Powell has expressed deep concern about the nation's balance sheet, noting that the current path Congress is on, spending more than the U.S. takes in, is the real problem, not the absolute debt figure itself. He warned the Fed will monitor inflation expectations very carefully before making any policy adjustments. This matters for the cash positioning story in a specific way. The Federal Reserve is effectively trapped. At its April 29th meeting, the FOMC left the federal funds target range at 3.5 to 3.75%, acknowledging that Middle East developments have increased uncertainty around the economic outlook. The Fed's median projection still points to only 1 quarter-point cut in 2026. One cut. In an environment where the economy is showing deceleration signals, where real wages have turned negative for the first time since April 2023, where consumer debt delinquencies are at multi-year highs. Credit card balances stood at $1.28 trillion at the end of Q4 2025. Aggregate delinquency worsened, with 4.8% of outstanding debt in some stage of delinquency. Transitions into serious delinquency ticked up for credit cards, mortgages, and student loans simultaneously. This is not a single stress point. This is stress across multiple consumer debt categories simultaneously. While the Fed cannot cut meaningfully because inflation is still running at 3.8% as of April 2026 against a 2% target. That is the trap. The economy is slowing. Consumers are stressed. But inflation will not permit the relief that historically comes from rate reductions. The Fed is watching both the floor and the ceiling simultaneously, and it cannot move toward either. Smart money understands this trap, and the response to a trapped Fed is not to chase equity returns at 21 times earnings. It is to hold cash, collect 3.5% in government money market funds, and maintain the optionality to deploy when the trap breaks, in whichever direction it breaks. Subscribe to Capital Briefing if this is delivering the structural intelligence you have been looking for. Turn on notifications. The next video examines the specific conditions that would trigger institutional capital deployment out of cash. What signals smart money is watching? What levels and what indicators would represent the entry point that all of this accumulated liquidity is waiting for? Subscribe now. Then let me explain the third layer of this story. The one that connects what is happening in cash markets to what is happening in gold, in sovereign debt, and in the global monetary architecture. Moody's downgrade of U.S. sovereign debt from AAA to AA1 in May 2025 renewed focus on the country's fiscal sustainability. It highlighted growing concern over the persistence of substantial budget deficits even amid solid economic growth. This backdrop is contributing to a more cautious outlook on the US dollar. Three major rating agencies have now downgraded US sovereign debt. This is not a sensational fact. It is a structural data point about the trajectory of fiscal credibility. The share of global reserves held in US dollars has fallen from 72% in 2002 to 59% in 2024. The euro's share of global reserves declined from 28% in 2008 to 19% in 2024. Meanwhile, the yuan has tripled its share of reserves since 2016. This is the de-dollarization story told without drama, not a collapse, a gradual, measured, documented structural shift in how the world's central banks are holding their reserves. Over 2 decades, 13 percentage points of dollar reserve share have quietly migrated elsewhere. Where is some of that migrating? Central bank gold demand began 2026 strongly, with estimated net purchases of 244 tons in Q1, up 3% year-over-year. During the quarter, central banks had to contend with heightened uncertainty on multiple fronts. The conflict involving Iran, the US, and Israel added to an already fraught geoeconomic environment, driving greater volatility across markets, including gold. Poland is leading global gold accumulation in 2026, adding over 20 tons, more than any other central bank so far this year. This purchase is part of a broader multi-year plan to reach 700 tons, reflecting heightened security concerns on NATO's eastern flank. The freezing of roughly $300 billion in Russian central bank assets in 2022 marked a turning point for global reserve management. That last sentence contains everything. The freezing of Russian reserves in 2022 was the moment when central banks around the world understood that dollar-denominated reserve assets are not neutral. They are subject to the geopolitical decisions of the United States government. The response has been quiet, systematic, and now 3 years old. Central banks are diversifying out of the instrument that can be frozen and into the instrument that cannot be. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be debased by a foreign government's monetary policy decision. This is not a conspiracy theory. It is the documented purchasing behavior of the world's monetary authorities, confirmed by the World Gold Council's quarterly data, observable by anyone with access to IMF reserve statistics. Now let me connect these layers to the cash story in a way that most retail investors have not fully processed. The cash that is accumulating in money market funds is not the same thing as gold. It is not performing the same function, but it is responding to the same underlying conditions. And understanding the difference between the two signals helps decode what different categories of capital are actually doing. Money market cash, the $7.75 trillion in U.S. government funds, is institutional capital parking in the safest liquid U.S. instrument available. It is earning 3.5% while it waits. It is positioned to be deployed rapidly when conditions change. It is not a statement of distrust in the dollar. It is a statement that equity valuations are too high and the risk-reward does not justify deployment. Central bank gold, the 244 tons purchased in Q1 2026 alone, is a different category of repositioning. It is sovereign capital moving into an instrument that is immune to the geopolitical weaponization of the dollar system. It is long duration. It does not earn yield. It is not waiting to be redeployed into equities. It is a structural reserve asset being rebuilt after decades of neglect. These two flows are happening simultaneously. They are not contradictory. They represent two different types of smart money responding to two different categories of structural risk. Now let me tell you what both of these flows have in common, and why that commonality is the most important signal in this entire analysis. Both are a bet against the continuation of the current structure. Money market cash says, I do not believe the current equity valuations are justified, and I am waiting for the structure to correct before I deploy. Central bank gold says, I do not believe the current dollar-dominated reserve architecture is stable over the long term, and I'm building an asset base that will survive whatever replaces it. Neither of these positions is dramatic, neither is a prediction of imminent collapse. Both are rational, evidence-based responses to observable structural conditions by the most sophisticated allocators in the world. and neither of them is being communicated clearly to the retail investor who is still holding a portfolio built on the assumption that the current structure continues indefinitely. Let me now address the commercial real estate layer, because it is the most underreported structural stress in the current banking system, and it connects directly to why cash and liquidity are being prized at institutional levels right now. Around $875 billion in commercial real estate debt in the United States is scheduled to mature in 2026. Many of these commercial property loans were originally issued during the period of extremely low interest rates following the global financial crisis and during the pandemic, when borrowing costs in the United States were at historic lows. Regional and community banks hold around 31.5% of outstanding commercial mortgages. CMBS delinquencies are at 6.59%, reflecting stress in specific property types. Banks are using loan modifications, extending and restructuring rather than accepting losses outright, as a way of managing exposure without triggering recognition of losses on their balance sheets. Extend and pretend. This is the phrase that risk managers use privately. It means that distressed loans are being modified, given extended terms, reduced payment schedules, technical reclassifications, to avoid having to mark them as non-performing on a bank's balance sheet. This is legal, it is common, and it means that the stress in commercial real estate is not visible in the reported delinquency numbers at its actual scale. Research published by Wharton found that reported delinquencies in commercial real estate may understate actual distress by a factor of 4, not 4%, 4 times the reported level. Under realistic stress scenarios, many regional banks become undercapitalized. This is the sleeping variable in the current financial system. It is not a crisis today. It becomes a crisis when the extend and pretend strategy runs out of runway, when loans cannot be extended further, when the properties cannot refinance at current rates, when the banks that are carrying these modified loans at face value have to recognize them at market value. When that happens, and the timing is uncertain but the direction is not, the banks that are most exposed are not the large national banks with diversified balance sheets. They are the regional banks that concentrated in commercial real estate lending because it was their competitive advantage during the low-rate period. This is the banking fragility layer of the cash story. Institutional capital is pricing in the possibility that a subset of the regional banking system enters a stress period within the next 12 to 24 months. Holding cash in government money market funds, backed by U.S. Treasuries, not by bank deposits, is a partial hedge against that scenario. You are not in a bank account when your money is in a government money market fund. You are in short-term U.S. government obligations. If a regional bank fails, your money market balance is not affected. This is a meaningful distinction, and it is one that sophisticated capital has been acting on quietly. Let me close with the framing that I think is most useful for understanding the moment we are in. Every major wealth transfer in modern financial history has followed the same structural pattern. A period of extended asset price inflation, driven by cheap money and expanding risk appetite, creates a market where valuations disconnect from underlying economic reality. Sophisticated capital recognizes the disconnect early and begins accumulating the position that benefits from reversion, which is always at its core a liquidity position, cash. Short-duration government instruments, the ability to act when others cannot. Then the reversion occurs. It can be triggered by a rate shock, a credit event, a geopolitical disruption, or simply the exhaustion of the forces that were sustaining the overvaluation. The specific trigger is almost never correctly predicted in advance. The direction of the eventual move is almost always visible to those who understand the structure. When the reversion occurs, the people who hold cash do not panic sell. They are the buyers. They acquire assets from the people who were fully invested, are now facing margin calls or liquidity needs, and have no choice but to sell at prices that represent the dislocation that intelligent capital was waiting for. Berkshire's cash pile has reached record levels 3 times in the past 3 decades, and each episode preceded a major market dislocation. The current position is roughly triple the 2019 peak. Each prior instance delivered the dry powder to buy world-class assets at panic prices: $397 billion in dry powder, $7.75 trillion in money market funds, 244 tons of gold purchased by central banks in a single quarter. These are not three separate data points. They are three separate expressions of the same institutional judgment. The current structure is overextended, and smart money is positioning for what comes after. The public is still largely operating on the assumption that the current structure continues. That assumption is reflected in equity PE ratios of 21 times, in consumer debt at record levels, in the continued chase for yield in assets pricing in perfection. The wealth transfer that happens in every major cycle does not transfer from rich to poor or from institutions to retail. It transfers from the unprepared to the prepared, from the fully invested to those who held optionality, from those who believed the structure was permanent to those who understood it was temporary. Cash is back because smart money has decided that the cost of being wrong about the timing of a correction is lower than the cost of being wrong about the magnitude. That calculation was made quietly. It was communicated through positioning, not headlines. And now you know it was made. Subscribe to Capital Briefing now if this video gave you something that changes how you read financial positioning going forward. Turn on notifications. Leave one comment, one word if you want. Are you positioned for the continuation of the current structure or for what comes after it? Because that question is the only one that matters right now. The wealth transfer has already started. The side you end up on depends on when you understood that.